Copper, the big squeeze. Earlier this year, I highlighted that it was about to get very spicy in the copper market. There were several signals that were flashing that made me pay attention. And as we discussed, the inventories were declining, the EV mania was in full force, economies were starting to reopen, and it was only a matter of time before generalist investors connected the dots. And now the mainstream investor, along with the Reddit, TikTok, Twitter finance gurus, are making the case for copper moonshots. But the actual substance to the sizzle is this. The world needs a lot of copper. Today, copper, the actual metal, and copper producers are up over 30% year to date, recently taking out the all-time high of the price of copper per pound set back in 2011. That's the chart you're looking at right now. Much to the irritation of the gold and silver bugs, who have had a very tough 2021 thus far, because they're waiting for their day in the sun. Copper producers have done very well and have completely destroyed the performance of the gold guys. That's the miner year-to-date performance. The gold are the gold miners and the green are the copper miners. As you can see, year-to-date, the copper miners are up 34% and the gold miners on average are down 17%. Copper 101. Copper is a key input into construction and infrastructure projects, power lines, appliances, and vehicles. So, as you might expect, there's a positive relationship between copper demand and macroeconomic growth. This is why copper's known as Dr. Copper for the macroeconomy check on its health. The pie chart you're looking at right now breaks down the copper demand by the end user. You can see 12% industrial, building construction, 30%, equipment 30%, infrastructure 15%, and transportation's 13%. Economies are reopening globally, infrastructure investments are being made, and citizens are doing their best to get back to some form of a normal life. Ultra-low interest rates and highly accommodative central bank policies have incentivized enormous amounts of capital to be put into work to try to grow the economy. Copper supply and demand 101. Previously, I highlighted the world's ability to warehouse less copper, which I believe is part of the general decline in inventories. The Amazon just-in-time delivery approach is a cost saver to producers and downstream manufacturers, so it works when the economy is fully efficient. But right now, due to the pandemic effects, the economy is not fully efficient. We've all seen the pictures on the internet of the bare aisles in the grocery stores and the hardware stores, but the same thing is actually happening in the copper market. As a result, demand is beginning to outstrip available supply and inventories are falling in a big way. The chart you're looking at right now is the total amount of copper held in inventories at the major exchanges like the London and Shanghai around the world. And as you can see, the general decline is obvious, but the steep drop this year is considerable as the supply chain bottlenecks have made it challenging for manufacturers to get supply. This has led to a heavy collapse in the copper inventories, most notably in London, the LME, where we've seen inventory levels decline by over 40% since mid-September. So this next chart is just the copper inventory of the LME, the London Metals Exchange, and look at that from mid-September 2021 to November 10th. That's a little over 40% drop. Get to know the copper cash contract. Copper for immediate delivery, known as the cash contract, is at its all-time high relative to copper contracts for future delivery. The difference between two contracts is known as the spread. In the copper world, the most referenced spread is the cash contract to the 3-month delivery. This compares the price of copper today to the price of copper 3 months from today. When short-term copper demand is very high, prices for copper today will be higher than prices for copper 3 months out. Right now, as of November 10th, this spread is at an all-time high. The chart you're looking at right now is the LME, the London Metals Exchange copper price, and it's the cash to the 3-month contract differential. And you can see we've highlighted on the far right, this is the highest spread between cash and 3 months contract ever since the LMEs reported these numbers. ELON, Electrify Me. What the world is finally beginning to understand is that copper is directly linked to electrification. Electric vehicles, charging stations, wind turbines, and new transmission lines all need copper and lots of it. For example, an electric vehicle needs over 150 pounds of copper. Conventional power production requires approximately a ton of copper per megawatt, or 2,204 pounds of copper per megawatt. So what about renewables? I'm glad you asked. Renewable technologies require over 8,000 pounds of copper per megawatt, almost 4 times the amount of the conventional power. As the world goes towards net zero, ESG, and a greener world, the new world, the green world, will require a lot more copper out of the earth. Look at this chart, for example. This is just the copper electrification requirements of the EVs and its charging stations, renewable energy, HVACs, and just smart buildings. And this is current, 4 years out and 9 years out. You can see the conservative growth rates, and the trend is your friend. But look, we're still early to the copper story, and the runway is growing longer. Last Friday, U.S. lawmakers passed an infrastructure spending bill totaling $550 billion. Fiscal stimulus packages globally are estimated to be trillions of dollars over the coming decade. So it's safe to assume that Dr. Copper should be a beneficiary, meaning higher prices, including copper stocks, which have been on a tear the past 12 months, as we discussed earlier today. One of the copper companies featured in my premium research service exploded out of the gates from $1.40 all the way to $14.50 this past summer. That's a 936% profit for people that bought shares at the $1.40 on the first days of trading. Here's the cool part about it. 2 things. The first ever report on this company, you got it, Katusa Research. The second cool thing is my subscribers didn't pay $1.40. They got it for 50 cents. The KRO subscribers, the effective gain was a lot higher. For subscribers that participated in a special deal that I published on and was the first to publish on, the effective cost basis of those exact copper shares that went to $14.50 a share was actually 50 cents. That's 28 times return. That's pretty cool. There's a chart of that exactly there. So what is the conclusion? Skate where the puck and the money is going. Right now, my team is laser focused on the decarbonization theme. Renewable energy, electric vehicles, and carbon offsets all play major roles. I believe governments around the world are going to tax the high polluters and use that cash to subsidize the switch to greener economies. In the next month's premium report to subscribers, the KRO, that's the December issue, for the first time ever, and actually the first time ever in the stock market, I will release a mega list of companies and the calculated impacts of the price of carbon on each producing resource company. Not just oil and gas, not just the precious metal companies, but also the base metal producers. This granular assessment allows us to look for big winners and avoid overnight balance sheet destruction and massive impairment charges of some well-known names. If you want the list along with my top investment ideas and research, click here to become a subscriber. Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.